Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
So today we're digging into Strive Incorporated, ticker AST, and specifically its radical transformation. I mean, this is a company that did a complete pivot, went from a struggling social media operation to a full-on Bitcoin treasury company. It's now holding, 7,525 Bitcoin, acquired through a really complex leverage strategy.
And that complexity has just proven to be, well, profoundly punishing in this market. This whole debate is urgent because as of right now, mid-December 2025, ASST is languishing. It's near 79 cents. That's an 8.57% drop today alone, and just a staggering 87% collapse over the last 3 months. So the question is this just temporary stress on a high potential asset, or is the market correctly pricing in a structural failure that's basically irreversible?
Exactly. That's the core question. Is Strive engineered as this high beta vehicle to maximize exposure to a potential Bitcoin supercycle? Or is its capital structure just inherently flawed and, ultimately destructive to shareholder value? I'm going to argue for the former. I think this is unparalleled, sure, high risk, but unparalleled leverage that's poised for a dramatic technical rebound. And the short squeeze potential is just massive.
And I'll be arguing that the structural weaknesses here, the extreme dilution, the fixed cost burdens from the preferred stock, and the dominance of institutional shorting make this stock a high-risk trap. I think it's destined for further and perhaps permanent value destruction for common shareholders.
Look, Strive's mandate is pure. They call it unapologetic capitalism, and it's focused entirely on maximizing the one metric they think matters: Bitcoin per share. This isn't just some incidental investment. It's a dedicated corporate strategy. The recent acquisition of Semler Scientific, that was a tactical move to increase their visibility, their regulatory standing, and clear a path toward index eligibility. It's all about positioning themselves to become the dominant vehicle for corporate Bitcoin exposure. The leverage just comes directly from that capital structure, turning the equity into a kind of synthetic derivative on their treasury.
I see why you emphasize that leverage. I do. But the whole launchpad theory, it requires you to just ignore the basic arithmetic of the common share count. This transformation has resulted in extreme, unprecedented dilution. We've seen the shares outstanding balloon to around 905 million by September of 25. That's a 43,500% increase from early 2024.
Right.
That level of dilution just fundamentally changes the game. It raises the market cap you need for any meaningful share price appreciation. It means even if Bitcoin doubles from here, the company's market cap has to overcome the sheer weight of those 905 million shares just to get the price back into the double digits.
But that dilution has also fueled the speculative engine. The retail enthusiasm, the Vivek factor, this persistent launchpad thesis, those are real, powerful sentiment drivers that can propel a stock far beyond its intrinsic value in a bull market. You see technical analysts all over the forums pointing to this crucial double bottom support they've identified, somewhere between, 38 and 90 cents? So you take that technical setup, you combine it with the exceptionally high short interest, we're talking 21.44% of the public float, something like 89 million shares sold short, and you have the structural ingredients for a massive forced price move the second shorts have to cover.
I'm just not convinced by that because the high short interest looks to me like systematic institutional calculation, not, volatile retail speculation. And the underlying financials are just screaming distress, which undermines any technical setup you can find. The trailing 12-month net income is a negative $223 million. Trading below $1 puts them at immediate risk of NASDAQ delisting. The price-to-book ratio is at 0.74. That is a clear distress signal that tells you the market is pricing in poor governance and very high future financing risk. And let's not ignore the cost basis problem. The average cost for a big chunk of their treasury is $103,000. Their asset base is currently upside down, facing massive unrealized losses, while Bitcoin is trading below 90,000. Let's look closer at that financing structure because that's where the real danger is. We have to talk about the variable rate Series A perpetual preferred stock, this SATA. Now, management loves to champion this as avoiding common shareholder voting dilution, but let's be really precise about what it does. SATA is essentially perpetual debt that's masquerading as high-yield equity. It imposes this massive non-negotiable fixed cost obligation through its dividends. It's the company's financial Achilles heel.
Okay, but why is that fixed cost inherently destructive? If the capital efficiency it gave them allowed them to acquire 7,525 Bitcoin, an asset that is widely expected to see massive appreciation, surely that potential upside outweighs the interim fixed cost.
It's destructive because when Bitcoin's price stalls or declines, which is what's happening right now, putting their assets underwater, this mandatory dividend forces Strive into what I call an infinite dilution loop. They are compelled to raise new capital, usually by selling more dilutive common stock, just to fund the fixed payments they owe to the preferred shareholders. It just accelerates the erosion of the common stock's book value. It's a structural penalty on the common shareholder during every single downturn.
That's a powerful, but I think an overly pessimistic framing of the instrument. I would argue SATA is a strategic Bitcoin amplification toggle. It efficiently raised the capital they needed without immediately flooding the market with voting common shares, so it preserved management's control, and it attracts a specific yield-focused institutional investor, one that's often insulated from the common stock's volatility, especially since those dividends are often structured to be classified as return of capital for tax purposes. The risk of servicing that dividend is manageable if the core strategy is sound.
But the 79-cent price reflects the market already pricing in that precise failure. The market's discount isn't based on some short-term fear. It is a concrete fear that the company cannot service that dividend without issuing more dilutive common stock. This isn't theoretical. That P/B ratio of 0.74 confirms the deep distrust. The market is screaming, "We believe you will be forced to dilute further, so we are discounting the common equity right now based on that guaranteed future issuance."
I think the singular focus on financing risk ignores the signs of extreme market stress that often come right before a massive relief rally, especially in a name this heavily shorted. The trading dynamics suggest market makers are under real pressure. We have to look at the microstructure. We saw a massive spike in fails to deliver, FTDs, on November 12th. It reached 24.6 million shares.
And for the listener, we should probably clarify what that means. A fails to deliver event is when the sellers, so predominantly short sellers, could not actually deliver the shares they sold within the required settlement period.
Precisely. And that staggering volume of FTDs suggests aggressive, potentially even naked, and ultimately unsustainable short selling. It indicates serious liquidity stress in the settlement system. This is structural evidence, not some speculative rumor, for a coming short squeeze. The shorts have overcommitted and they're struggling to locate shares.
I'm sorry, I just don't buy that the high short volume indicates an inevitable forced squeeze. And let me tell you why that FTD data is misleading if you look at it in isolation. The persistent high short volume points directly toward highly calculated institutional distribution, not irrational panic. We see this dominance in dark pools. These are off-exchange venues used for large block trades. I mean, look at the data from early December. The off-exchange short volume ratio is consistently near or above 60%. It was 60.19% on December 9th, 58.46% on December 12th.
I have to acknowledge that the consistent short volume off exchange is a powerful indicator of institutional bearishness. I agree. It certainly dampens volatility.
It does more than dampen volatility. It establishes a systemic managed price ceiling. Institutions are systematically selling these large borrowed blocks privately to mitigate the downward price impact on the public exchange. This methodology creates a persistent ceiling that retail momentum just can't break through. They're controlling the price descent. And on top of that, the low days to cover ratio, sitting around 1.02, suggests these same institutions believe they can get out of their positions relatively quickly without causing a forced cover. That fundamentally undermines the entire retail launch pad squeeze thesis.
While I acknowledge the low days to cover, we have to look at the supply side. That's the immediate source of volatility. The low ratio assumes a constant supply of shares to borrow, which is clearly not the case. Data from December 15th showed the intraday availability of shares to borrow just plummeted to as low as 250,000 at certain points. That tells you that the lendable supply of shares is being exhausted. So if the institutional distribution just pauses for a moment, or if Bitcoin suddenly moves up, the lack of available inventory could trigger massive volatility and severe pain for those shorts, despite their technically low days to cover. The market is stretched to the breaking point.
And the most immediate tangible threat to the shareholder, the one that transcends all these microstructure debates, is compliance. The price of 79 cents puts a company at high risk of a NASDAQ delisting notice. They need to be above $1 for a sustained period. And we have precedent here. They already did a 1-for-5 reverse stock split back in July 2024 to cure a previous compliance issue.
That's a compelling point, given the history of failed reverse splits.
But think about what a second split would mean. Historically, companies forced into repeat reverse splits suffer continued severe selling pressure because it just signals persistent weakness. It destroys shareholder confidence. So the common shareholder who's already survived one of these events is now faced with the possibility of another.
That's true regarding the pattern, but we have to consider the immediate context that created this 79-cent price. This price action is largely a reaction to global events, not a pure reflection of Strive's intrinsic health. We saw disappointing tech earnings from Oracle and Broadcom, plus these global macro fears about the Bank of Japan tightening policy. I mean, these events affect all high-beta, leveraged assets indiscriminately. Right now, the stock is trading at an estimated 26% discount to its book value per share of around $1.07.
But the market is giving you that discount for a reason.
The reason is fear. But if you value the 7,525 Bitcoin holdings correctly, the fundamentals just do not justify the current discount. That disparity suggests the correction is emotional, and compliance can be regained through a quick recovery, avoiding another disastrous split. This is the opportunity. The market is offering leveraged exposure to Bitcoin at a 26% discount to its own stated book value.
That requires the shareholder to trust that the market will quickly agree with that book value assessment, a trust that is completely undermined by the 0.74 PB ratio. A price to book of 0.74 means the institutional market is pricing in the high risk that Strive may be forced to liquidate or dilute further just to service those added dividends, especially given the high cost basis of their assets. The discount is an accounting of structural risk, not an emotional oversight. So ultimately, while the theoretical potential for some explosive upside exists in a Bitcoin supercycle, the structural risks, for me, they just dominate the equation for the common shareholder. The sheer volume of 905 million shares, the non-negotiable liability of the SATA dividends, which guarantees dilution in a downturn, and the concrete evidence of controlled institutional distribution in dark pools, together, they create a mechanism where common stock value is structurally drained. I think the financial engineering itself is likely to accelerate the erosion of value unless Bitcoin sees an unprecedented immediate rally that validates their high-cost basis.
I see the dilution fears. I do. But I maintain that Strive engineered itself to be the most volatile, highest beta instrument available to get exposure to digital assets. The extreme leverage, combined with their 7,525 Bitcoin, offers exceptional upside that for some outweighs these risks, provided you fundamentally believe in the Bitcoin supercycle. The current price of 79 cents reflects peak distress, maximum fear, and it sets the absolute floor for a dramatic technical rebound if the institutional short thesis falters.
So we're left with this core conflict. You see this complex financial architecture as necessary leverage, a calculated risk to exploit a generational opportunity. Whereas I see it as guaranteed dilution, a mechanism for accelerated downside risk that traps common shareholder capital in a structural decline.
Exactly. Both of our views are entirely predicated on the binary outcome of Bitcoin's price relative to Strive's very aggressive and currently underwater cost basis. The whole question is whether that leverage is worth the structural fragility.
And the key distinction remains that the complex structure fundamentally alters the probability of success versus just holding Bitcoin directly. The true common share value of ASST remains obscured. It's obscured by extreme volatility and the structural opacity of dark pool trading, which currently benefits the well-funded institutional shorts. It is a terrifying corporate experiment that relies on a single massive upward move just to survive.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.